Hi, this is Daniel, and you're watching Unrivaled Investing. This is a no hype, mission focused channel trying to find you exceptional companies and unrivaled investments. I'm looking for potential multi-baggers, folks, types of stocks that could potentially go up hundreds or even thousands of percent over time. If you want to follow my personal journey as I try to find these companies, go to unrivaledinvesting.com. Today we are talking about Dr. Michael Burry, arguably one of the most successful investors of all time. A lot of folks don't realize that before he made his great call in the great financial crisis, he was a microcap investor, small cap, medium sized investor, and this is while he was studying to become a doctor, and he was crushing it. He was crushing it as a hedge fund manager. And the great financial crisis, that was just one of many bets that he's made over his career that have turned out very well. There's a long history of really thoughtful investing, and he takes more of a let's try to find cheap bargains approach to investing. A lot of folks don't realize a lot of the companies that he's invested in prior to, let's say, the last few years. A lot of folks think of him as GameStop or the great financial crisis. There were a lot of other companies that he bought that turned out very, very well. And so recently, today, came out his second quarter 21 holdings, one of which was a bet against Cathie Wood's ARK ETFs. And that is, so this is Cathie Wood, her ARK ETF, ARKK, and he's effectively betting against it. And I've actually done a couple of videos talking about sort of the dynamic there, where in one he thought there could be liquidity concerns. And now I think there's another element to it that I'll be talking about in this video. Let's do a breakdown of what does Dr. Michael Burry hold, and what are sort of the key themes that you should expect as you look through his portfolio. Maybe there's an opportunity to piggyback on what he's doing. And so the first quarter video that I did covering Dr. Michael Burry's first quarter portfolio update was I effectively said it's a theme of betting on chaos. And thematically, I'd argue it's much the same, betting on higher rates, betting, leverage bets on growth at a reasonable price, consumer staples, and short overvaluation and hype. And just to broadly understand what's sort of the theme and why that is a broad theme that actually covers all these different things, different bets, is that if you have higher interest rates, then a lot of the more speculative stocks that are unprofitable but depend on, let's say, their future cash flows, let's say a decade from now or 2 decades from now, those stocks can get hit the hardest, because higher rates ultimately result in a re-rating on these unprofitable companies. And so here it is, what you find with what Dr. Michael Burry is he's got a portfolio with hugely cash generative companies trading at really low multiples. They might have a lot of debt, but they generally are steady Eddie types of companies, very stable free cash flow portfolios, and oftentimes they're actually unrivaled companies. They may not have the flair that you would see in a Cathie Wood ARK investment portfolio, the company that's growing super fast. And arguably, she also tries to find these unrivaled companies that are growing a lot, but maybe the business model just isn't at scale yet. There's significant money losers, or it's highly volatile and highly dynamic. And so as you look at his portfolio, it's really saying, hey, because he does have a bet effectively saying interest rates will go up. And that might be a direct result of recognizing the radical monetary policy from the Federal Reserve, where if the Federal Reserve has to taper their 120 billion plus in quantitative easing each month, that will result in potentially higher interest rates. And if you have higher interest rates, you sort of have this trickle effect where all assets reset. And very recently, the whole Treasury curve, US Treasury curve, was under 2%. So that shows you how this sort of bond bubble, and everyone can agree, the super low interest rates does create this sort of bubble mentality, feeds to all other assets, resulting in excessive valuations. And so if you see that bond bubble start to pop, how does it impact everything else? And that's where thematically you'd say, oh, okay, so if you have higher interest rates, you want to find the steady Eddie things that you think will be growing at a reasonable pace, consumer staples that no matter what, investors are, consumers are going to need to buy them, and ideally buying it at a reasonable valuation. And he's short the overvaluation and the hype, companies. And so, to go through, his top bets, and this is based on the market value of, or the nominal value of his options. So this isn't the dollar amount that he's invested. This is the nominal value of the options, what they represent in total. And so nearly $1 billion bet against Tesla. That's a Tesla put. That's, I would argue, I've done a video on it, I can leave a link to it, where Tesla's valuation, even if you assume really excessive, incredible growth in the years ahead, it's just going to be really tough to beat those expectations. It's really going to be tough to beat the fact that valuation has expanded so significantly. I'll talk about that in just a little bit. A Facebook call, effectively betting on Facebook. Facebook, which in full disclosure I own as well. Facebook is a very strong company generating strong growth and significant free cash flow. This, at the end of the day, you have something like 3 billion monthly active users, nearly half the world using one of their products. And it's a question of like, well, is this really going to change if you have an interest rate reset environment? TLT, that's a put where he's betting against TLT, i.e. this is long dated bonds, saying, hey, long dated US Treasury bonds, their prices are going to go down, hence interest rates going up. This is, I'd argue, direct response to the tapering aspect. And you see, well, in the last 2-3 months, this has actually gone against him. Broadly over the last 6 to 9 months, this has actually been heading in that favor of higher potential interest rates. Then you look at Google. Google's very similar to Facebook. You have a growth at a reasonable price type of valuation. Full disclosure, I own Google as well. Oops, my Google's talking back to me. And so, looking at Google, solid free cash flows growing at a reasonable clip. Will people still keep searching? Will all these sort of crazy moonshot bets start paying off for Google? Then you have a number of healthcare plays that he's bet on. Once again, if you were to have an economic reset, either because of higher rates or because of just some sort of geopolitical tension, we're starting to see that right now. What type of companies do you think will still be around where consumers will continue to use their products? Are the valuations reasonable? And so, like, for example, healthcare bets include McKesson. This is a call option betting on. This is effectively pharmaceutical distributor. Then you have Cardinal Health, another pharmaceutical distributor. Then CVS, which is, you're looking at the pharmacy, the retail chain. So these are all very steady businesses regardless of the environment. And he's trying to say, hey, can I get this at a reasonable valuation? Kraft Heinz, another call option. Walmart, another steady business, no matter what. I'd argue even in a downturn, this business is going to do well because folks need their basic staples. And so even if you do have an interest rate reset environment, let's try to find things where the business still holds up. And then lastly, in terms of the top option bets, you see that he's made that bet, this $30 million bet, not huge relative to some of the other things. I'd argue Tesla is just way bigger. But you could see this ARK put is on there. It's one of his top option bets. So these are, very interesting bets. I've just done a walkthrough of what, sort of what sectors you're looking at. He has a bunch of smaller sort of equity bets that he's made. These are generally super cheap stocks, including bets effectively on prison companies where it's like, yeah, these companies aren't going anywhere. People are still getting arrested. People are still, serving jail time no matter what. These businesses will be sticking around. He also has some bets on some super cheap oil and gas companies. Some of these trade at like 3 times free cash flow. And so if you're willing to underwrite the fact that oil prices are currently where they are, you could see and if you think they'll stay where they are, let's say over the next 5 years, some of these are just grand slam potential stocks that he's done, some of these oil and gas plays. So, when you think about what you're looking at between Dr. Michael Burry and Cathie Wood. I've done a previous video effectively saying pick your fighter. I think a lot depends, and I'm very curious what you think, so leave a comment below. A lot just depends on what you think the valuation is. Do you think valuation matters? And that's really what it comes down to for a lot of these things, because Cathie is trying to find unrivaled companies that I believe that she's trying to find unrivaled companies. Many of the companies have that sort of marking, have that sort of characteristic, and he's looking for incredibly stable, companies that trade at, cheap multiples. At least that's what it looks like, or reasonable multiples at a growth. And so the question is, well, wait a second, what sort of environment do you think we'll be in the years ahead? Does it matter that a lot of the names Cathie Wood owns is sort of the frothy valuation type? Yeah, they might be great companies, but maybe she's overpaying for the valuation. So I'd love to hear whose take, which camp you're in. And you can see, this is effectively what he's betting against. Once again, another bet on Tesla. These are the top holdings in the ARKK ETF. So Tesla is a perfect example where Tesla's valuation multiple expanded by 5x since 2019. That's a huge multiple expansion. So that's the question of like, well, wait a second, will they be able to deliver on this sort of, 5x better expectations, 5x higher? So it does get tougher. I'm not saying the market cap grew by 5x. The market cap did even more than that because Tesla's business was growing as well. What I'm saying is the multiple that folks were willing to pay for Tesla stock went up by 5x. That is a huge driver of the share price. And so you need to ask yourself, well, wait a second, could that actually reset in the years ahead? Because if that did, that would be a huge headwind for investors, literally an 80% headwind for investors to consider. And that's part of the reason why, when I did my Tesla video, I just said I can't underwrite that valuation. Unity Software, it's this fantastic company. I don't disagree. This is an amazing company, quite possibly unrivaled. I've done a video on Unity, but I still just can't underwrite the valuation. Like I'm looking at 30-40% growth. I'm like, man, this multiple is just too rich. Even if you assume 30% plus growth for the years ahead, it's just too tough for me to see it. Then you look at something like Shopify, where since 2019 multiple is expanded by 3x. If you were to see a valuation reset just to back where it was in 2019. Keep in mind, in 2019, it's not like interest rates were at 5 or 7%. They were still close to zero interest rate policy. So you could have, this reset to where it was in terms of valuation multiple, and that would be a huge headwind for Shopify. Same thing for Twilio. Twilio saw a 2x expansion. So a lot of these companies, these are cash losers at this point where they're unprofitable. This is exactly the type of portfolio where a higher interest rate environment could result in multiple reversion, a valuation multiple reversion, where a lot of these get a significant haircut, even if the underlying business dynamics continue to suggest that they're unrivaled or continue to just crush it in terms of their growth. And that's sort of the challenge. So that's why I'd love to hear your take of like, hey, Cathie Wood camp where valuation doesn't really matter. It's more about, pie in the sky. Let's see just crazy growth. Or the Dr. Michael Burry approach of like, hey, you know what? I want to find things that trade at, let's say, 10 times free cash flow. Or maybe they trade at 20 times free cash flow, but they're growing at a good clip, like a Google or Facebook. I'd love to hear your thoughts on that. Who do you think is right? And if you want to follow my personal journey, as I try to find potential multi-baggers, go to unrivaledinvesting.com. First week of the month, I call out my full portfolio. By the end of the month, I call out a potential multi-bagger. There's also an exclusive Discord community where I'm interacting with the Unrivaled Nation on a daily basis. If this video was helpful for you, please make a point of hitting that subscribe button and hit that thumbs up. Thanks so much for watching.